Um, Thanks for joining us today. My name is Shay. For those of you who don't know me, I'm a tax advisor and a business owner of Kessler Financial. And I'm joined today by Ally Puentes, who's a principal broker and icon agent with EXP Realty out of Central Oregon. And today we're going to talk specifically about tax savings for realtors. Um, I like these webinars to be interactive. So if you have questions as I'm going through things today, feel free to put them in the chat, and Ally's going to be monitoring that for me. Thank you so much, Ally, for agreeing to put this on with me. And do you want to take just a quick minute to introduce yourself?
Well, hi, I'm Ally. I am just grateful that you're doing this. As a real estate agent, I feel like we always think about this in the middle of tax season. So I'm excited to be proactive this year and maybe get some questions answered before the middle of the season.
Definitely. Yes, it's much better to be proactive than try to look back and change things after the year has closed. So this is a great time to be learning about things. And hello, for those of you who are just joining us, you haven't missed anything yet. We're just getting started. I did want to start with just talking about the different business structure types. And this particular webinar is kind of focused on those of you who would still be reporting your income on a Schedule C on your personal tax return. So sole proprietors, self-employed people, even if you register as an LLC with your state, it's taxed the same on your tax return and it goes on your personal tax return. Now, if you form an LLC with someone else who's not your spouse, then you have a partnership and you would have to file a separate entity return for that partnership. Same with S corporations and C corporations. Those are separate entities that have their own business tax return. And with partnerships and S-corps, what happens is the income and deductions on the business return flows through to your personal tax return by way of a K-1 form. So the business tax return generates a K-1 form that then you report on your personal return. And we'll talk towards the end about when it might be beneficial to elect to be taxed as an S corporation, because that is something that you can choose to do if you are a single member LLC. You do have to have your business registered as an LLC in order to make that election. But for today, the deductions and stuff I'm going to go over here in the beginning are specific to if you're paid on a 1099 and you're reporting your income still on your personal tax return as a self-employed individual. So hopefully that applies to you if you're here, but we will touch on the S-corp towards the end. So deductions, the things that you can subtract from your gross income in order to reduce the tax that you pay. Because when you are self-employed, not only are you paying your regular income tax that you're used to federal and state, but you're also paying self-employment tax, which is the Social Security and Medicare portion of your tax liability. So when you're employed on a W-2, you'll see that withheld from your pay, Social Security and Medicare taxes, and then your employer actually covers half of those for you. So half of them are withheld from your pay. Your employer covers the other half, but when you're self-employed, you have to pay that whole thing, and it's 15.3% of your net income. So it can be a pretty big chunk of your income, but the more deductions that you can claim, you're going to reduce that net income down and reduce your self-employment tax. So auto expenses is a big one for realtors. You do a lot of driving around. If you are able to buy a vehicle and have it 100% business use, wonderful. You can obviously write off everything that has to do with the car. However, that's not the case for most of us. I use my car for business and personal purposes, so those expenses have to be allocated. Now, the IRS allows you to either use your actual expenses or you can take the standard mileage rate. But since you're going to be having to come up with a percentage of what the business use is, you really have to track your mileage no matter what, because that's how you're going to determine what percentage of the use was business versus personal. So in my experience with my clients, it's usually a lot easier and more beneficial to just use the standard mileage rate. So for 2024, it's 67 cents per mile that you drive for business. And that rate is supposed to take into account the cost of fuel, insurance, oil changes, gas, the fact that your vehicle is depreciating in value because you're using it. So that's the simplest way to do it. But if you want to claim actual expenses, a lot of times I can look at it in my software and tell which way is more beneficial. I'm not sure if if software like TurboTax will allow you to do that. But if it's more beneficial to use the actual expenses, you can do that. And you can switch back and forth, but if you start with the standard mileage rate, you can't later switch over to actual expenses on that same vehicle. So if you think you might want to switch back and forth, you'd want to start with the actual expense method. And then you would have the option to be able to switch if it was more beneficial to do it a different way. The next deduction that's a big one for people that are self-employed is the home office deduction. The IRS wants the home office to be 100% used for business. So if you're just using your laptop at the dining room table or in your bedroom, they're not going to allow the home office deduction. They want it to be something that's specifically dedicated to business use. And they used to even be pretty picky about it being a totally separate room in your house, but they've gotten a little more lenient on that. So it can be like my office is a part of my dining room. There's no walls separating it from the dining room, but it is a desk space that I use 100% for business. So I could measure the square footage of that space. And then I would need the square footage of the whole house. And again, that would be used to come up with a prorated percentage of home office. And then you would have to have all your expenses totaled for your utilities, your rent or mortgage interest, property taxes, insurance. And then you would get to deduct that percentage of all of those expenses against your business income. So it can be a lot to keep track of, but it can be a pretty substantial deduction against your business income. So I definitely recommend taking it if you are able to. Um, Again, I'll talk a little bit more about this when we're talking about electing to be taxed as an S corporation, but employees can't take the home office deduction anymore. You used to be able to take things like mileage and home office, even if you were an employee, if you know, were required to work from home, for example, but the Tax Cuts and Jobs Act of 2018 did away with all employee-related business expenses. So if you're paid on a W-2 as an employee, you can't deduct things like your home office and your mileage, but as a self-employed person, you can. Contractors, if you pay other people to help you out in your business, whether it's covering an expense for a seller to get something repaired, or you're hiring a virtual assistant, those are obviously deductible expenses. You shouldn't have to pay tax on that income that you're paying out to someone else. However, if you pay them $600 or more during the year, you're supposed to give them a 1099. And that's the IRS's way of tracking that that money that you're deducting is actually being claimed by someone else as income. The only situation where you wouldn't have to do that is if it's an incorporated business that you're paying. But if you're paying another LLC or another individual, then you should issue them a 1099. And in order to do that, you're going to need to collect their social security number or EIN number. So you can do that with a W-9 form, kind of similar to the W-4. You would give that to your contractor, have them fill it out, preferably before you pay them, because if you have to go back and try to get that information after the fact, it can be difficult. And oftentimes, if you don't collect that information up front, the person might think that you're getting paid under the table and that they're not going to have to report it. So just something to think about if you are paying other people. Hiring your kids. I don't know how many of you here today have kids that are under 18, but one of the benefits of having a sole proprietorship as opposed to an S corporation or a C corporation is that you can pay your kids who are under 18 to do work in your business, and they are not subject to the Social Security and Medicare taxes. So while your net income is subject to those taxes, if you're able to pay it out to them, they don't have to pay those taxes. And kids under 18 that are your dependents can earn quite a bit of money without having a federal tax liability. I think for 2024 is about $14,000 that they could earn and not even have to file a federal tax return. So that's $14,000 that you're deferring to them. Now you're not paying tax on that money, you're not paying self-employment tax, and neither are they. So it can be a great way to save money in taxes. Here in Oregon, that filing threshold is a lot lower. If you pay them $1,250 or more here in Oregon, they would need to file a state tax return. But even then, the tax savings is still going to be a lot greater than if you were reporting the income on your tax return. So if you decide to do that, just make sure you keep some sort of record, a timesheet in Google Sheets or a handwritten piece of paper of when they're working and what they're doing in case the IRS were to audit you. They would probably ask for something like that. But kids, I mean, I hired my son as young as 10 years old to start shredding papers for me. There's not really an age limit when they're your own kids. Another thing that people will do a lot of times is have their kids be pictured in their advertising. So then technically they're modeling and you can kind of pay them a higher rate for that than minimum wage salary. So that can be something to think about if you have kids and you want to help teach them good work ethic and save money on taxes at the same time. Pre-tax retirement and health insurance are both deductible expenses. However, these two items do not affect the self-employment tax. So if you're looking at the net income from your business, these wouldn't be business deductions necessarily. So I probably wouldn't recommend running them through like your business bank account just because you want your books to match your tax return ideally. But these do help save you money on regular income tax. So when you're preparing your tax return and you have your business income and all your regular deductions, you arrive at a net income figure. That number is what's going to carry over to your tax return. And then you'll get to deduct out things like retirement savings and your self-employed health insurance expenses. For retirement, most people are eligible to put about $7,000 a year into a traditional IRA. But as a self-employed individual, you could potentially open a SEP IRA or possibly a 401k. I'm definitely not an expert on the different types of retirement accounts, but I know that as a self-employed individual, you can put a lot more into those accounts if you don't need the money to live on. The maximum SEP IRA contribution limit for 2024 is $69,000 or 25% of your net income, whichever is lower. So you could put quite a bit of money away for retirement. And again, this would save you money on regular income tax, but it wouldn't necessarily help you out with the self-employment part of the taxes. And lastly, just overall, what the IRS says about deductions for your business is they want them to be ordinary and necessary. So I feel like that leaves a lot of room for interpretation. And if you can justify that what you're spending the money on is ordinary and necessary for your business, then it can be a legitimate deduction. So yeah, I mean, the obvious ones that you could think of, things like your licensing, your continuing education, office supplies, insurance, advertising, all of those things would count. Charitable contributions don't count as a business deduction. They're, again, can go on a separate part of your tax return, but they don't always make that big of a difference. So what I like to advise my clients to do is if you're wanting to give to some charity, if there's any way you can turn it into an advertising and marketing expense by asking them to list your name on their website or, put your logo on a t-shirt or something like that, then you can classify it in your books as a marketing expense, and then it's going to be a legitimate business deduction. The other thing with deductions that I like to mention, gifts. I know gifts is pretty standard in the real estate industry when someone closes on a house. The way the IRS code is written, and it hasn't been adjusted for inflation for a very long time, is that you can only gift $25 per person per year as a deductible write-off. So technically, if a couple buys a house, you're only allowed to spend $50 on their gift. Now, I know some accountants are sticklers about this and they will go in and audit their clients' books and not allow anything over $50. I personally don't do that. I think that it's completely ordinary and necessary to gift larger than $50, and it's not our fault that they haven't raised that due to inflation. So I let my clients deduct more. I don't know if it would stand up an audit or not, but I do feel like that is still a legitimate business deduction. So if you want to just lump it all into the gifts category in your books, it's probably not going to be questioned.
Shay, question on that part.
Sure.
What if we think of it as a gift, but it has our logo or something branded in there?
That's a good question. So they also have limits for branded items that are very low and haven't been adjusted for inflation. I think that the way the code reads, you're not supposed to spend more than like $5 or something on your branded items. But again, I mean, I've ordered sweatshirts, hats, tumblers, lots of things that are more than $5, and I've never seen that be questioned. So in general, yes, if you can put your logo on it, that does make it now an advertising marketing expense. so it wouldn't count towards that gift limit. This made me think of something else too. Clothing is usually not deductible, even if you need to dress nice for your clients. If it's something that the IRS thinks you could wear every day, then it wouldn't be deductible. So they're going to allow things like steel-toed boots for construction workers and things that you wouldn't necessarily wear around every day. But if you're wearing a nice suit to meet with your client and you could also wear that to church on Sunday, then you wouldn't be allowed to deduct it. However, if you put your logo on it, then that becomes a uniform and you can deduct it. So I just met with an attorney recently who was going to do something creative with a little monogrammed embroidered thing, just very small on the cuff somewhere. So it's not like you're wearing a sweatshirt with a big logo across the front, but just strategically put it on there somewhere so that she can write off that stuff because she was having to buy expensive clothes to go to court. So yeah, that was a great question. All right. Record keeping. It's definitely good to save your receipts. I know a lot of people have kind of went to just saving their bank statements, and that might stand up in audit, but it also might not, especially for things like Amazon purchases. They're not going to be able to tell from your bank statement whether you were buying stuff for your house or for your business. So they're probably going to want an itemized receipt. That's not the best example because you could look up your Amazon receipts if you needed to pretty easily. But when you're buying stuff at Costco or at the store, it is good to save that receipt. And it doesn't have to be a paper copy. In fact, digital copies are better these days because a lot of the paper that the receipts get printed on will fade over time. So if you were to be audited a few years down the road, the paper might be blank and then it wouldn't be helpful at all. So, and the IRS wants you to save records for 7 years. So after 7 years, you can start shredding stuff, but it is good to save things for 7 years. I personally think it's great to hire a professional bookkeeper if you can afford it. You're an expert at what you do. They're an expert at what they do. It can take a lot of stress off of your life. You know that it's done right. You're not stressed out at tax time trying to gather everything up. I would say probably what I see most often is missed deductions because people haven't kept track of it throughout the year. So they're trying to scramble at tax time to gather everything in one place, and you just miss stuff if you're not tracking it throughout the year. So if you're able to hire a professional, I think that that's a great option. If you want to do it yourself, there's great software out there that will help do that for you. QuickBooks and FreshBooks, I think, are pretty similar. I haven't used FreshBooks myself, but I've heard good things about it. QuickBooks Online is what I use, and I love the app for your phone. You can actually take a picture of your receipt. Like I go to the post office a lot. I don't want to save those receipts. I can just snap the picture and it saves it attached to the expense in the software, and then I can just throw the receipt away. It can also be really helpful if you set it up to pull the transactions in from your bank feed. You're not really having to enter anything yourself. You just go in and tell it what expense category to classify something as, and then it will even learn over time that, every time I go to the post office, it's for postage, and every time I go to Office Max, it's for office supplies. So yeah, that can be a great option. But if you're doing it yourself, have a professional look it over like quarterly to make sure everything's going where it's supposed to go. I've had a lot of clients show up at tax time, and sometimes it does weird things. Like I had a coffee shop last year and all their Square transactions were being pulled in twice somehow. And she didn't notice because she wasn't reconciling her bank account. So her income was overstated by probably $50,000. And if I hadn't have known her personally, I wouldn't have thought to question it. Like it would have looked fine on paper, but I knew her and I knew her business wasn't doing super awesome. So I was like, this doesn't really make sense. And we went in and found that there was lots of duplicate entries. So it's good to have somebody look it over. I also mentioned Excel here. When you're just starting out and you don't have a lot going on, you could track it in Excel or in like a Google Sheet or something. That way, at the end of the year, you're not trying to manually add things up. At least the spreadsheet can be used to total things. And I usually recommend that you have a column for the date, where you bought it from, the amount, and then try to classify it to the best of your ability so that you can sort it at the end of the year and it will sort into the different categories that you spent money on. So if I'm preparing a tax return for a client, it is helpful to have it in Excel versus just written on a piece of paper or in a Word document where you're still having to total things on your own. I talked about saving the receipts at the beginning. Keeping a mileage log, that is another question that the tax return will actually ask you if you're deducting mileage. It'll ask if you have a log and if it's written. Written can mean digital too. It doesn't have to be handwritten, but they do want you to have some sort of system in place for tracking your mileage. I used to keep a little notebook in my car a long time ago, and I'd just write down the starting odometer and ending odometer for all my business trips. Now I use an app called Mile IQ that I've been really happy with. It tracks all my drives, and I just go in when I have time every week or two and swipe right for personal, left for business. You can put a little note in saying what the business purpose was, and it will also track if you want to keep track of your medical and charitable miles. Those are also deductible miles that you can use on the other part of your tax return. So keep a mileage log. And this is kind of specific to Portland, Oregon area where I am. It's good to track where your sales are occurring because even if you don't live in the city of Portland or in Multnomah County, if you're selling houses in those jurisdictions or otherwise earning income from within those jurisdictions, they do have their own local taxes. And you need to know how much of your gross sales came from those jurisdictions. So if you can have some way in your system of tagging those and tracking them so that they can be easily totaled at the end of the year, that will help save you time.
Shay, question on the Mile IQ report.
Mm-hmm.
Do you accept it without notes being filled in?
Yeah, I do. I don't know what the IRS would say about that. They might ask you to go back and specify where you were going or what you were doing, but I don't need the notes to be in there. I honestly don't even need the mileage log. If you just tell me that you have it, I can put it on the tax return. And I have had clients in the past that have been audited and you can go back and recreate the log for the auditor. That's not illegal or anything. It's just a pain in the butt to have to do. Good question. All right. So when to elect S-corp status? This is a question that I get a lot, and I want to preface it with every professional kind of has their own opinion on this. And I have noticed sometimes that attorneys recommend it more often than I personally would. And I feel like that's to get your money because you're going to pay them probably to draw up the documents and stuff. But where the tax savings comes from when you elect to be taxed as an S corporation is the money that the company is making above and beyond what you would make reasonably doing what you're doing. So like we talked about earlier, when you're self-employed, all of your income, all of your net income is subject to the self-employment tax, which is the Social Security and Medicare payroll taxes. When you elect to be taxed as an S corporation, now you have to pay yourself on salary, which you can't pay yourself on a W-2 when you're a sole proprietor or single member LLC. That's not allowed. But when you elect to be taxed as an S corporation, you now have to pay yourself on salary. So whatever you decide to pay yourself on salary is still subject to the same amount of self-employment tax. It's just taxed a little differently now. Now you're paying half of it as an employee and your company is paying the other half as the employer, but you are the company. So you're still paying the whole thing for the salary portion, but whatever you make above and beyond that salary is not subject to the self-employment tax. So that amount is going to be, you're going to have a 15.3% tax savings on the amounts above and beyond your salary. So I usually, for most of my clients, just as a general rule, say wait until you're netting about $100,000. But again, this is super subjective. If you're not full-time in your business, then 100,000 might be too big of a salary. But I would say on average, and I mean, you guys know this better than I do, but I feel like 100,000 is a pretty reasonable salary for a full-time realtor. How do you determine the reasonable compensation? There's whole companies that you can hire that will do a detailed analysis of what you should reasonably be paying yourself. That can be kind of expensive. I've usually just do my own market research on salary.com or something, or, ask around to your friends. There's lots of different ways to be reasonable, but you need to be paying yourself a reasonable salary. And then if your company is making more money than what you would reasonably pay yourself, that would be the best time to start thinking about electing to be taxed as an S corporation. Um, Another good way to think about it would be, how much would you have to pay someone to come in and do what you're doing in the business? Like if you needed to step out entirely and hire someone to do what you do, if you would still be making money above and beyond what you're paying them, then you should elect to be taxed as an S corporation. It's going to benefit you to make that election. Um, and it's pretty easy to do. It's nice. You don't have to change your EIN number or anything. If you are already registered as an LLC with your state, it's just a form that you file with the IRS that says, I would like to be taxed as an S corporation. And they want you to file that by March 15th of the tax year that you're going to make the election. There is a late election available. So if circumstances happen and for some reason you do want to make that election midway through the year, you can go back and do that. But again, one of the requirements is that you pay yourself on salary. So you really kind of want to start it fresh with the new year so that you can have that in place and be actually operating as an S corporation, because that's one of the things they're going to ask you when you make the late election is, have you already been running your company as if it was an S corporation? One of the benefits of becoming your own corporation essentially is being able to take advantage of the Augusta rule for self-rental. I'm not sure if you guys have heard of this before, but this is actually something that's available to anyone. You can rent out your own primary residence for 14 days or less in a tax year and not have to pay tax on that income. So this can be really beneficial for people that live in the same city that the Super Bowl comes to or the Olympics. I had a friend a couple years ago in Phoenix who rented out so she subletted her apartment that she was renting on Airbnb for some crazy amount of money. I think she got $10,000 for a week during Super Bowl because she was walking distance to where it was happening. So that was tax-free income to her. Now, when you have a corporation, your business can rent from you personally. So you could have your monthly board meetings at your house. You could have company parties. You could have client appreciation events. Be creative. I mean, you could do all kinds of things. So now it becomes a deduction to your business that doesn't have to get picked up on the other side as income. So I like to tell people about that. And then the other thing that changes when you become an S corporation, like I talked about earlier, there's no more employee related deductions for like the home office and the mileage. So when you become a corporation, now you're no longer self-employed, you're an employee of your business. So how to still be able to take a deduction for those items is by setting up what's called an accountable plan. And that's just a document that you put into effect in your business that says that your company is going to reimburse you for the home office and they're going to reimburse you for your mileage. And it can either be a flat rate or it can be a form that you submit, like this is how many miles I drove this month, and then the company reimburses you for that. So again, it becomes an expense through the company, but that reimbursement isn't taxable income to you. So that's how you would still be able to write off those sort of things after you elected to be taxed as an S corporation. I know that can be kind of confusing. Are there any questions around when to elect S corp, what that really means, practically speaking? But yeah, that was everything that I had to cover. I know it was a lot really fast, but hopefully it was helpful. And I'm always available for one-on-one consultations if this sparked your interest and you want to learn more or you have questions that I didn't cover here. When I send out the link to the recording, I'll post a link to my scheduling site and you're welcome to book a consultation.
Shay, quick question. Did you mention on the S-corp that you're not allowed to pay your kids in that way? Is that what you said?
Oh, yeah. Thanks for bringing that up. So, for some reason, when you are an S corporation, you can still hire and pay your kids, but now you have to pay the Social Security and Medicare tax. So,
Mm,
you save on that if you haven't elected to be taxed as an S corporation. You can still hire them, and it can still be a great way to save taxes, especially for people that don't live in Oregon. I mean, Oregon's filing threshold is so low that you're going to probably create a filing requirement for them. But people in Washington, for example, they can pay their kids $14,000 a year and their kids don't have to file any sort of tax return for it. You don't necessarily have to issue a W-2 because there isn't any Social Security or Medicare tax. However, if you think that you might put money into their Roth, for example, that's something that people will do a lot of times because you need to have earned income to contribute to a Roth. But if you're a child earning income, you can start a Roth IRA. So if you're going to do that with the income that you're paying them, I would recommend issuing a W-2 so there's a record with the IRS of the earned income. That way the Roth contributions are being tracked that way. But that can be a great way to start a savings account for your kids that's going to grow tax free for their whole life, and they're going to be able to pull it out tax free when they retire.
okay, a couple questions. What about trainings?
Trainings are deductible, and I say try to find them somewhere fun, because if you like go to Vegas for a training and that's your primary purpose, and the days you're there, you're spending at least half the time on work related stuff, so four hours a day during work days, then the trip is deductible. So all your travel expenses would be covered. Meals are usually only 50% deductible, so you still pay with your business account and run it through the business as a deduction, but when you look at it on the tax return, only 50% of it is actually going to be a deduction.
Okay. And then also would like to learn more about real estate investments for clients who are investors.
Well, I don't know who asked that question, but I did a webinar a couple months ago on that sort of thing. So you can find that on my YouTube channel. And I love helping real estate investors, and I have a lot of great information on that. So I would love to talk to you after this webinar. We could go over some stuff. And I also, as a realtor yourself, there's some benefits to investing in real estate that the rest of us kind of don't have, because usually real estate is considered a passive activity. So passive losses can't offset active income. So a lot of times rental real estate will look like a loss on your taxes because you get to depreciate the property, and depreciation is an expense that you claim for money that you didn't really pay out. Um, so most people wouldn't be able to take those losses and have it offset their other income. But as a realtor, you are able to do that because you're considered to be actively participating in real estate, since that's your profession.
Very good. Any other questions?
Well, thank you guys for joining me. I don't want to take up too much more of your time, but I really appreciate you coming today, and I hope it was helpful.
Yes, great info. Thank you.
All right. Have a good Friday.
You too.